Foreclosures across the U.S. are up 18% year over year, but in California it's even worse. In cities like San Diego and Sacramento, multifamily defaults have surged nearly 25%, marking the sharpest spike since 2008. So the question is this the perfect storm or the next big trap? And more importantly, should you be buying into this downturn or waiting it out? You know what they say, cash is king when the market crashes. In this video, we'll break down the data, spotlight where institutional money like BlackRock is quietly moving, and reveal 3 high-yield cities where you can still buy at a discount and position your portfolio ahead of the rebound. Stay with me, because in a few minutes, you'll see exactly where the smart money's going and how to get ahead of the next wave of buyers. Let's start with where we are now. Across the U.S., housing volatility is no longer a coastal phenomenon. It's national. While some cities are still digesting the hangover of 2021's price boom, others are now firmly in correction territory. According to CoreLogic, national home prices dropped 3.7% year over year as of Q1 2025. But zoom in on California, and that number triples in places like San Jose and San Diego. We're talking 10 to 12% declines in just 12 months. Look at this chart. California Home Price Index, first quarter 2023 to first quarter 2025. You'll see just how steep the descent has been in formerly high-growth metros. So what's causing it? A combination of macro and micro stress points. Interest rates remain elevated, with the Fed holding steady between 4.75 and 5.25%. That's pushed 30-year mortgage rates north of 7%. At the same time, wage growth has stalled. NAR's affordability index sits at its lowest point in a decade, hovering around 92, well below the 100 threshold that signals balanced affordability. That's not just a data point. It's a red flag for demand-side weakness. You know how this works. When affordability breaks, demand slows. And when demand slows, inventory piles up. Redfin data shows active listings in Los Angeles are up 22% from last year, while median days on market have stretched from 19 to 44 days in Orange County. But that's only half the story. Distress is quietly growing in the multifamily sector, especially in Sunbelt states. CoreLogic just reported a 19% year-over-year rise in multifamily delinquencies nationwide. California leads the pack, especially in secondary metros like Fresno and Bakersfield, where over-leveraged developers are facing loan resets at double the original rates. Many of these are now entering REO status, bank-owned properties ripe for institutional acquisition. Take a look at this chart. Multifamily foreclosure filings, California Tier 2 cities, 2023 versus 2025. You'll see a sharp uptick beginning in late 2024. Now, here's what investors often overlook. Distress doesn't just mean disaster. It signals opportunity. Institutional players like BlackRock and Starwood Capital have already started deploying capital into distressed multifamily assets in Southern California. In fact, a recent SEC filing showed BlackRock acquired $300 million worth of foreclosed apartment blocks in Riverside and Ontario at a 17% discount to appraised value. They're renovating, rebranding, and leasing up for 5 to 6% stabilized yields. From what I've seen watching this pattern since the 2008 cycle, institutions move early and quiet, but individual investors have something powerful on their side: agility. You're not managing billion-dollar funds. You can move faster, negotiate better, and get creative on financing. Here's a strategy I've been sharing with clients lately. Target 4 to 12 unit multifamily assets in high foreclosure zip codes where institutions aren't active. In Southern California, that might be pockets of San Bernardino County or outskirts of Sacramento. These areas still have rental demand, but pricing is soft and sellers are motivated. Consider this chart. Rental yields, California secondary cities, Q1 2025. Fresno is yielding 6.2%, Bakersfield 6.4%, while larger cities like San Diego are below 4.5%. That yield gap tells you where the cash-on-cash return lives right now. Later in this video, I'll show you which 3 California cities are offering the best combination of foreclosure pricing and rental upside. But for now, let's touch on how this downturn could become a launchpad for smart positioning. Migration trends are shifting again. Remember the post-COVID exodus from California? That's starting to reverse slightly. Census data from early 2025 shows a 4% net migration into mid-sized California cities like Modesto and Stockton, largely due to falling home prices and remote work normalization. If you're playing the long game, that signals rental stability and eventual capital appreciation. Now, let's talk about leverage. Many investors I've worked with are sitting on liquidity and debating whether now's the time to go all in. But here's the truth. If you're waiting for the bottom, you may already be too late. JP Morgan's housing recovery forecast pegs Q3 2025 as the inflection point, assuming rates soften and inventory clears. That's just months away, and we're already seeing early signs. Multiple offer activity is quietly returning in Sacramento, according to local MLS data, especially in the sub-800,000 segment. And consider this, investor offers versus retail offers, California housing, Q1 2025. Cash investor activity is outpacing financed buyers for the first time since 2020. But it's not just about timing, it's also about structure. US-based investors can leverage 1,031 exchanges to roll gains into distressed markets without tax impact. International investors, especially from the UK, Australia, and Canada, need to navigate FIRPTA and varying capital gains tax rules. That's where the structure of your acquisition matters. Inbound LLCs, TICs, or partnering with domestic syndications can give you the exposure without the tax drag. Let me give you a quick example. A Canadian investor I advised last year purchased a foreclosed fourplex in Palm Springs for $950,000 cash. The property needed $120,000 in rehab, which they funded directly. Within 6 months, it was leased at $7,000 per month total. Net income after expenses, $54,000 per year, or just over 5.6% yield. And the kicker? They're already fielding refinance offers from regional banks at 70% LTV, allowing them to extract capital without triggering FIRPTA until disposition. And this is happening more often. You might not get the steepest discounts in Los Angeles or San Francisco, but in the right zip code, with the right structure, you can lock in stable returns while positioning for appreciation as the cycle turns. So where are the smart investors looking now? Stay with me, because in just a few minutes, I'll reveal the 3 cities in California showing the best entry points for high-yield, low-risk multifamily acquisitions heading into 2026. And before we wrap up, I want to leave you with one last strategy that's proving especially effective for savvy investors in 2025, even in this declining market. It's what I call the yield cushion play. Acquiring distressed multifamily assets in secondary markets with stabilized rent demand, renovating modestly, and locking in tenants before the broader recovery inflates acquisition costs. Investors doing this now in parts of Riverside, Modesto, and even Bakersfield are already seeing cap rates north of 6%. Without the bidding wars, we're starting to see creep back into San Diego and Orange County. Take a look at this chart. Housing inventory versus buyer demand, California 2024 to 2025. You'll notice the gap is narrowing fast. Supply is peaking while buyer inquiries, especially cash investor inquiries, are beginning to rise. That's your window. From what I've personally seen working with investors in Southern California over the past few years, the ones who act early, not recklessly but decisively, are the ones who win. You know how fast things move in this market. Waiting too long can mean watching the best deals get scooped up by institutions, or worse, by your competitors who simply moved faster. So let's recap what matters most from today's video. First, Foreclosure rates in California are rising, but that's not a warning sign. It's an entry signal for those with liquidity and a strategy. Second, institutional buyers like BlackRock are already positioning themselves, betting on recovery before the headlines catch up. Third, smart investors are targeting overlooked metros with high rental yields, negotiating direct-to-seller, and leveraging legal structures to stay tax efficient. And finally, the most profitable plays aren't in waiting. They're in acting, while fear still lingers. So now I want to hear from you. Which U.S. housing market do you believe has the strongest upside in 2025? Are you looking at Los Angeles, or are you focused on more yield-driven plays like Fresno or Stockton? And more importantly, are you buying now or still waiting on the sidelines? Let me know in the comments. If you found this video valuable, like it and share it with anyone serious about making strategic real estate moves this year. And if you don't want to miss the next wave of data-driven global housing strategies, hit that subscribe button now. Because at EstateScope, we don't just watch the market, we decode it for investors like you. See you in the next video.